Hello, welcome back to CBSE Board Economics. I'm Saddam Hussein here. Today we are discussing Unit 2 of Macroeconomics. This unit is Money and Banking. This unit carries 6 marks in the board examinations. There are two separate chapters here. One is Money, which is relatively a smaller one, and one is banking. Under money, you have two, three questions, not many. In fact, there used to be lot many topics earlier. They have all been deleted now for 2021 board exams. Let's discuss what you have in the money chapter. The first one, you have define money in economics. What exactly money means in economics? Money in economics means anything, any commodity that acts as a medium of exchange. Medium of exchange means which is easily accepted all over the country. To buy any commodity, it becomes easier for you to exchange. You can buy a car with the money, you can buy a pen, you can buy a pencil, you can buy an ice cream. That's medium of exchange. It is accepted all over the country. And then you have as a unit of value. These days, we compare all commodities in terms of money. That's a unit of value. A car is more expensive than a pen. That's a unit of value. How do you say that a car is more expensive than a pen? Because you compare in terms of money. A car will cost you something like 5 lakh rupees, whereas you can buy a pencil or a pen for 50 rupees. And standard of deferred payment. What exactly standard deferred payment? Deferred payment literally means future payments. We can make all the future payments in terms of money. That's you can give a check, you can give a demand draft, so it won't lose its value. That is, money is a standard of deferred payment and is a store of value. What exactly is store of value? Even if you keep money for a long time, it won't lose its value, unlike goods or commodities which are perishable. So now we got the first question, define money in economics. Any commodity, anything which acts as a medium of exchange, as a unit of value, as a standard of deferred payment, and store of value. Just remember these 4 points. Any commodity which acts as a medium of exchange, as a unit of value, as a standard of deferred payment, and which acts as a store of value is defined as money in economics. And then you have, where do we get the money from? What are the sources of money supply in the economy? Remember, there are 3 sources of money supply in the economy. Where do we get the money from? Number 1 is the central bank. Of course, in India, the central bank is RBI. RBI issues all currency notes. This can be 2000 rupees, this can be 500 rupees, this can be 200 rupees, this can be 100 rupees, and any other smaller currency notes, except 1 rupee notes and coins. And where do we get these 1 rupee notes and coins? This we get it from the Ministry of Finance under the Government of India. They issue coins and 1 rupee notes. And the last one, commercial banks also create credit. Credit means they create credit. We can borrow money from the commercial banks. So let's read the second question. What are the sources of money supply? The following are the 3 sources of money supply in the economy. One is central bank, which issues all currency notes except the 1 rupee notes and coins. 2. Ministry of Finance, that's the Government of India, issues 1 rupee notes and all coins. And third one, we get the money in the economy through commercial banks, which they create credit. That is credit creation by the commercial banks. And the next question you have, What is supply of money in the economy at any given point of time? How much money we have in the economy? What is supply of money? Money supply in the economy refers to the entire money in the economy is currency held by the public. Either the money is in your hands, it can be in coins, it can be in terms of currency notes, or you have your money in the bank, that we call it as demand deposits with the commercial banks, which you can withdraw anytime. That's also hot cash currency in the economy. So what is supply of money in the economy, or at any point of time? Money supply in the economy refers to currency held by the public, number one, and demand deposits with the commercial banks. And next small question you have, what exactly are demand deposits in economics? Demand deposits means we all have bank accounts. We keep our savings in the banks. So whenever we demand, the bankers will give our money. This can be in terms of checks, or it can be with the help of withdrawal slips, we call it. So next we have one more question. What are demand deposits? Demand deposits are the deposits with the commercial banks which can be withdrawn by depositors with the help of a check or a withdrawal slip. That's it. You have, this is a small chapter, money. Then you have the banking. We recollect the topics which discussed in money. The first one in this, the whole unity, in this whole chapter, you have what is money, what are the sources of money, where do we get the money, and what is the supply of money in the economy at any given point of time, what are demand deposits. That's it. You learn these 4 questions. So this is, we're discussing today the second unit, money and banking, which carries 6 marks for your board examinations. The first one, you have defined money in economics: anything which acts as a medium of exchange, as a unit of value, as a standard of deferred payment, and store of value in economics is defined as money. That's the first one. And what are the sources of money supply? We discussed, I repeat again, there are 3 sources of money supply in the economy. What it means, where do we get the money supply? The first one is central bank, which issues all currency notes, notes except 1 rupee notes and coins. The second one is Ministry of Finance, that's the government of India, that issues 1 rupee notes and coins. And the third one, commercial banks also create credit. What is supply of money? That means supply of money in the economy at any given point of time. Money supply in the economy refers to currency held by the public. That is, whatever we have money in our hands, it can be in coins, it can be in terms of currency notes, demand deposits with the commercial banks. The second one is demand deposit, commercial banks, which you can withdraw on demand. And what are demand deposits? We just discussed it. Demand deposits are those deposits with the commercial banks which can be withdrawn by the depositors with the help of a check or withdrawal. Anytime you can withdraw. That's it. You have in the chapter money and banking. In the next video we will be discussing about banking. There are few topics in the banking to just tell you. In the banking you have 3-4 questions. The first one, you have differentiate between commercial banks and central bank. The second one, you have functions of central bank. This year they deleted a lot of functions of the central bank. We'll be discussing that later. And the last one, you have how do the commercial banks create credit. That's it for money and banking. This carries 6 marks. Please learn these 3-4 questions here. We define money, what are the sources of money, and what exactly money supply in the economy at any given point of time, and what are demand deposits. That's all we have time for today. So till we meet next time, it's goodbye from Saddam Hussein. Don't forget to share, subscribe, comment, and best of luck for your board exams. Goodbye.